Hey everyone, when you hear the words life insurance, what comes to mind? You probably picture one single, simple product, right? But what if I told you it's actually more like a giant toolbox, just filled with all these specialized instruments designed for very specific jobs? Well, today we're going to open up that toolbox and see exactly what's inside.
So yeah, if you've ever thought that life insurance was just a one-size-fits-all kind of deal, it's time to think again. We are about to dive into some of the most interesting and powerful niche policies out there, and you'll see just how tailored they can be for unique financial situations.
And that's really the big idea for today, thinking about these policies not just as insurance, but as specialized tools. A lot of these are actually really clever combinations, packages of different basic policy types, all engineered to solve very specific financial problems for you and your family.
Let's kick things off with the first set of tools in our kit. These are the ones designed not just for one person, but for covering the entire family unit, both efficiently and effectively. First up, we've got the Family Plan Policy. Now, you can think of this one as the multi-tool of life insurance. It bundles coverage for everyone under a single contract, which is super convenient. Typically, it gives you permanent, whole life insurance on the main breadwinner, and then it adds smaller amounts of temporary, term insurance for the spouse and the kids. And here's the really cool part. Any new children are often automatically covered with no extra cost.
Okay, so that's great for all-around coverage. But what if the specific job you need done is to make sure a monthly paycheck keeps showing up for your family even after you're gone? Well, for that job, we have two very similar but critically different tools.
Let's put the family income and family maintenance policies side by side. They both mix whole life and term insurance to provide that income stream. But the key difference, and listen closely here, is when that income starts. With a family income policy, the payment clock starts ticking the day you buy the policy. So if you pass away late in the term, your family gets payments for a shorter time. But with a family maintenance policy, the clock doesn't start until the date of death, which guarantees your family gets payments for the full specified number of years. It's a subtle distinction, but it makes a massive difference in terms of security.
Okay, next up in our toolbox, let's look at policies designed for pairs. This could be a married couple, sure, but it could also be business partners who need to ensure their joint financial interests. Say hello to the joint life, or as it's often called, the first to die policy. And yeah, it's pretty much exactly what it sounds like. It covers two people, and the policy pays out when the very first person passes away. This is an incredibly useful tool for things like paying off a mortgage, making sure the surviving partner isn't suddenly stuck with that huge debt, and by the way, it's also generally cheaper than buying two separate policies.
Now, let's flip that idea completely on its head. This is the joint and survivor policy, also known as second to die. Here, the policy pays out only after the last person covered has passed away. And you might be thinking, wait, why would anyone want that? Well, this is where its genius for estate planning comes in. The payout provides immediate tax-free cash for heirs to pay estate taxes, so they don't have to sell off assets like a family business or property. Pretty smart, right? All right, this next set of tools might sound a little weird at first. Insurance for children. And while it can cover final expenses, the real superpower here is protecting a child's future insurability. It guarantees they can get coverage as an adult, no matter what health issues they might develop down the road. So, the basic setup is just called juvenile insurance. It's any regular life insurance policy on a minor. A key thing to understand here is what's called third-party ownership. Basically, an adult, like a parent or a guardian, is the one who applies for, owns, and pays for the policy. The child doesn't even need to consent.
But inside this category, there's a particularly clever policy, sometimes called a junior estate builder. It's got a fantastic name, the Jumping Juvenile Policy, and trust me, it totally lives up to it.
Here's how it works. It might start with a pretty modest base value, say just $1,000. The premium is low, and it starts building up a little bit of cash value for the child. But then, something pretty amazing happens. When the child reaches a specific age, usually 21, bam! The face amount automatically jumps to a much higher number, often 5 times the original amount. And the best part? The premium doesn't go up with it, not one dime. And, this is critical, the child doesn't have to prove they're in good health. It's just a powerful way to lock in a financial foundation for them.
For our final section, we're going to switch gears completely. We've seen how these policies can build a financial foundation, but now we need to understand the powerful force that shapes them, tax law. I know, I might sound a little dry, but what the government did back in the 1980s completely changed the game, specifically to stop people from using policies as pure tax shelters.
It all kind of kicked off in 1984 when a tax act redefined what life insurance even was, mainly to curb some endowment policies that were growing cash value way too fast. But the real shakeup, the big one, came in 1988 with the Technical and Miscellaneous Revenue Act, or TAMRA. This was the law that drew a line in the sand and created a whole new category for policies that were starting to look more like investments than insurance.
And that new category is the Modified Endowment Contract, or MEC for short. In simple terms, a policy gets slapped with the MEC label if it's considered overfunded according to IRS rules. This means if you take a loan or withdrawal, your gains get taxed first as ordinary income, and there's a potential penalty. Totally different from the tax-free access you get with standard policies. So how does a policy get this label?
Well, it all comes down to something called the 7-pay test. Here's the simplified version. First, the IRS calculates a kind of speed limit for how much you can pay in premiums during the policy's first 7 years. That limit is based on the premium needed to have the policy totally paid up in 7 years. Now, if at any point your total payments go over that limit, boom, the policy is reclassified as an MEC. And the crucial point here, the part you really need to remember, is that this is a permanent change. Once a policy becomes an MEC, it is always an MEC.
So, as we've seen, it really is true. Life insurance is not just one thing. It's a whole collection of highly specialized, versatile financial tools, everything from family multi-tools to sophisticated estate planning instruments, each designed and regulated for a very specific purpose.
And that brings us to the most important question of all, looking at your own financial life. What are the goals you need to reach? To put it another way, what's the financial job that you need a tool for? Because now you know the right one is almost certainly out there. Thanks for joining us.